So hello guys, welcome back to another session of this charting analysis, and today I'm going to explain you a trade which I took in New York session, and the date for the day is 8 April. Okay, so 8 April New York session, I'm going to explain you about the trade which I took. Okay, so basically the trade which I took is from this point to this point. Okay, and there was some problem with my position sizing as I just came out of bath, so yeah, I was not able to calculate the position size properly because of some wet hands. Okay, so the one position sizing was 0.01, which was too loose. Okay, it was too short, and another position sizing was too heavy. Okay, so I have to exit both of the position to take in the correct position size, which was around 0.15, that is 15 microlots that I needed to take. Okay, now I have to around take this what do you call it, this trade. Okay, from this point to this point, but actually this trade was need to be taken from this point to this point. Okay, so there is a little slippage in the trade which I take, and it won me around $136. Okay, so let's dive into how did I take this trade and why did I take this trade, what is the reason behind this trade. Okay, so let's go on daily time frame to understand what is a bias. Okay, now if I see on daily bias, okay, now can we see that there is a daily bias change. Okay, so go on 1 minute, it's okay. So now the market of the XAUUSD was going higher and higher and higher. It was making higher highs, higher lows. So the market broke down. Got it? It shows us a change in the market structure shift, and then the price went back to what? It went back to the order block. Okay, and then it rejected from that order block to the lower point. Okay, so then again it took the buy stops and then again rejected too much. Okay, got it? Taking out these lows. Now it went back higher, then again rejected to go this back. Now with this rejection downwards, and the market was coming up and up and up, so I wanted some kind of rejection from this market. Okay, I wanted some rejection, so the market was going up, coming to order block, then going down, right? That's what I was expecting the market to do. So now let's get all the drawings back. Okay, I know it will be really hard for you to understand, a little bit hard for you to understand this drawing. Okay, so now you can't understand this right now. So now the market went back higher and then it broke down. So once it broke down, okay, and we know we are bearish, so we want it to come to an order block for it to reject from that point. Okay, so the price was slowly and steadily coming to some kind of order block to reject, and I was waiting for that rejection to happen. Okay, so let's go on a 15-minute time frame. Now if I see things on 15-minute time frame, they're not pretty much clear. Okay, now the rejection was shown from this point. Okay, but it was not tragic, right? We are in this particular green thing. You see this green, it shows the New York session, the yellow shows the London session, and the Asian, it this violet shows the Asian session. Okay, now let's see. So if we go on a 5-minute time frame, you will see one thing. I want because the rejection from was from this point, and this all up close candle can act as a water block. Okay, so now I was looking for some kind of structure. Okay, what I saw before the market went back higher, it take out these highs, and there is some fair value gap that has been made, and same fair value gap got inverted. Okay, so this is a powerful inverted and fair value gap both, right? So one side of this particular thing, as you can see, so from one side the fair value gap got inverted, the second side it is getting created, so both of them are lying in the same zone. So it's a kind of rejection zone where we will see some rejection. Okay, so here we are not following the order block because we have better thing to do with the fair value gap. Got it? Now let's see. So this was the rejection, and this particular midline is called consequent encroachment. I hope I am like teaching it right. This middle line is called consequent encroachment. Okay, so I was feeling that there should be some kind of rejection from this consequent encroachment. Okay, now the price came back to this point. Can you see that? Now we are in the, as soon as the price broke down, took some low out, we are waiting for the price to come back to this fair value gap to reject from that. Got it? Okay, now we are on a 15-minute time 5-minute time frame. Now we are waiting for the price to come back to that point. So today the price came back to that point. We want to see some the rejection, but can you see that one thing? Even before the market came back to this point, it got a little rejection. Okay, the market showed some rejection. Yes, it did. So then the can you see there is one problem with this? Let me raise this thing. The market didn't touch this fair value gap. We want the market to touch the fair value gap, and even before touching the fair value gap, it rejected. So it means what? It means this market is just trapping bears. How do I know this thing? Because can you see this thing? If I saw these two highs, can you see this high is greater than this high? It means the buy side liquidity has been built. Can you see that? fair value gap has not been taken, plus the buy side liquidity has been built, and this shows that the market rejection is not that much of confirmatory. Okay, it's not showing us some confirmation whether the market really or truly wants to go in there. Okay, so we have to wait, right? Because this market rejection is not that much good. Yes, the market came back to show some structure, okay, right, and then it rejected again. And this is a kind of like fair value gap that is made by the market. I think on the 15-minute time frame it made this fair gap. Okay, so market came higher, broke down, but we want some kind of key level to be reached. Here the key level is the fair value gap. The key level is not reached. It means our trade confirmation is not fulfilled. Okay, so yes, did I take a trade? Yes, I did take a trade, and yes, I lost $30 on that trade. Let me tell you that. Okay, I lost $30 in that trade when the market came back to this point. Okay, I took a trade. I took a trade for what? I took a trade for sell order. Okay, so I took a trade in here. I expect the market that it broke down. I was little less confirmative. Okay, the price has not. I didn't notice that the price has not reached the fair value gap. Plus, it has built some buy side liquidity. I don't want it to create some buy side liquidity. Okay, this is bad scenario. Okay, I don't want the market to show me some structure like this. Okay, this is bad structure. This is not what I like for the market to move on. Okay, I am not very confirmative with this one. But if the market comes back, okay, goes down, right, and then goes into a fair value gap, whatever it is, fair value gap, sell side liquidity, any kind of key level is reached, and then the market, and it should be higher, got it, and then it rejects lower and then goes back like this, then this is more confirmative structure. I hope you understand it now, right? Maybe you can utilize a fair value gap, or maybe some any kind of order block, okay, breaker block, any kind of thing to make an entry over here and set a stop loss over here. Okay, but in this entry, although I took it, yes, I am accepting the fact that I took it, but I was not seeing that key level has not been reached. Okay, I just saw, okay, the structure has been formed, let's take a trade. Okay, that's what I was thinking. So the market, let me just erase this point for a while. So the market, I took my entry out in here, got it, and I set my stop loss at this high. I was not, I was really thinking that okay, these are buy sell liquidity that has been created, which is not being taken. So the market is just trying to create some low, got it, and yes, I got stopped out. Okay, let me show you, and I did my trade around like at this low, got it. So yes, I got taken out when the market shifted higher. So now I'm more confirmative. There is a run on buy side liquidity. Can you see that? Yes, on a short term basis, there is a run on buy side sweep. Okay, so there is a buy side sweep, got it, and there's a run, plus the market is reaching a fair value gap. It means the market is reaching a fair value gap, plus there is a run on the liquidity. Now this is called higher time frame confirmation. Now let's go on a smaller time frame. Okay, I want to form an entry. Can you see that? So this is a candle, a higher candle made, then lower candle made. Okay, now you can see the higher candle which is made is too straightforward. Okay, over the experience you will know whether should I follow, at for this point, whether I should follow a fair value gap or an order block. If the order block is looking clear, follow the order block. Okay, if the fair value gap is looking clear, follow the fair value gap. Got it? Okay, so now the price came back to the fair value gap. Okay, price came up, it broke a certain low, okay, and then it came back high, so I took my entry at this point. Got it? But due to some slippage and wrong orders, see, it's not exactly at this point, it's just little below. Okay, so yes, I was not able to take the trade exactly at that point, but yeah, due to some late, and I was not able to calculate the position size. It's very hard to calculate the position size, but anyways, at least we took the trade and we didn't miss it out. So now I put my stop loss at the high of this white candle. You can see the high of this white candle. This is what I set as a stop loss. Got it? Okay, and now I know, because the market was, see, I wanted it to take some another sell side liquidity. Okay, let me show you where's the market. Okay, sorry. So the market was going higher and higher and higher. Okay, and I wanted it to take out this sell side liquidity, but it's really hard to predict this sell side liquidity to be taken, because if this sell side liquidity gets taken, it means this is a market structure shift on a higher time frame, on a 15-minute time frame. Okay, which is running since Monday, which is less confirmative. So I was like, okay, let's not wait, let's take our 1:3 risk reward ratio. That's it. Okay, so let's go on a mechanical 1:3 RR. So I went on to 1:3 RR. Okay, now I saw, okay, if I take my 1:3 RR, I can bounce rock from this order block. Okay, can you see that? there is exact bounce back from this order lock. Okay, this down close candles, this bounce back from that. Okay, and I took my entry out here, and at the same point the market reversed, because I know this particular you know sell side liquidity will not be taken at this point. Plus at this point you can see the end of this particular session is about to reach, and whenever there is an end of the session about to reach, the market will show some kind of reversal. Okay, whenever the kill zones are about to end. So I was like, okay, I can't see that thing. Okay, my position size was a little on risk, and it was a little harder to hold on to trade. So I was like, let's take it out. It was already following my 1:3 mechanical risk reward. So I was like, okay, done, let's get it done. Okay, so this was a trade which I took. Okay, $134. So yes, after a long time I have marked over $100. Let's see what I can do. I'm still right now in drawdown. Okay, and it's $230 from reaching drawdown. I have a account of $6,000. Okay, I'm trying to recover from the drawdown. Let's see what happens. Okay, till then, see ya, bye bye, have a nice day, keep studying, keep learning, and bye.